Welcome to The Explainer. If you've been watching the tech sector recently, you might reasonably think the market is rewarding companies simply for whispering the word AI 3 times in their earnings calls. For years, investors basically handed out blank checks to companies just for strapping shiny new AI features onto their legacy products, desperately chasing top-line revenue growth at literally any cost. But as of May 2026, well, the era of growth at any price is officially dead. We're setting the stage today for a massive structural shift in how Wall Street values technology companies. We've entered a totally new paradigm, and it's defined by a ruthless, unyielding focus on the bottom line. It's what institutional analysts are now calling the efficiency ratio play. Look at this reality check. Wall Street isn't buying AI growth anymore. It's buying AI-driven firings. It sounds brutal, I know, but this is the cold, dispassionate calculus of the 2026 market. The whole narrative surrounding tech layoffs has fundamentally changed. We aren't looking at those desperate defensive cuts we saw during the pandemic hangover, where companies were basically just trying to survive. Instead, the market is actively rewarding companies that are shedding 20% or more of their workforce with immediate 15% stock premiums. We need to understand exactly why that shift is happening and why it's happening right now. Okay. Let's dive into this massive divergence and how people are playing the market right now. The traditional retail investor is largely playing a super outdated game. They're out there buying the dip, chasing the latest AI hype, and praying for top-line revenue growth. But sophisticated institutional participants, they are looking somewhere else entirely. They are laser-focused on operating margin expansion. They're capturing massive 15% stock premiums by identifying companies that are utilizing highly calculated workforce reductions to structurally and permanently shrink their operating expenses. Make no mistake, this is a bottom-line reality check, not a top-line hype piece. So, to truly grasp this paradigm shift, here is our roadmap for today. 1. The new AI mass. 2. The compute for labor swap. 3. Cloudflare's agentic pivot. 4. Redefining the RPE benchmark. 5. The AI washing stock trap. And 6. Mastering margin-driven alpha. Let's get right into it. Starting us off with Section 1, the new AI mass. Now, what's really interesting about this slide is the distinction here, because it is absolutely crucial. Early AI was essentially just a shiny, fast chatbot that helped a human employee draft an email a little quicker, right? But agentic AI is an entirely different beast. Imagine a multi-layered software architecture acting as a complete structural replacement for a human worker. These agents actually have memory. They don't just draft an email. They negotiate a customer's refund, update the company's accounting software, log the interaction in the CRM, and then close a support ticket, all entirely autonomously, without a single human handoff. We're no longer talking about doing work faster, we're talking about complete workflow elimination. Which brings us perfectly to our second point, the compute for labor swap. This is the underlying mechanical engine driving this entire efficiency trend. We're witnessing the deliberate, highly calculated trading of human payroll for silicon. Companies are literally taking the millions of dollars saved on employee salaries and rerouting it directly into servers, GPUs, and compute power. Take Meta, for example. They laid off roughly 10% of their staff from a position of record profit. Why? Specifically to help fund a staggering $115 to $135 billion in AI capital expenditures. Snap cut 16% of its workforce, targeting $500 million in absolute cost reductions. Block cut nearly 40% of its staff to flatten middle management entirely and create what they actually call a mini AGI structure. They're fundamentally replacing direct recurring labor costs with fixed tools and infrastructure. Let's look at the premier example of this executing in the market right now, in Section 3, Cloudflare's agentic pivot. If you take only one thing away from this explainer, let it be this exact divergence. In May 2026, Cloudflare cut 20% of its workforce. That's about 1,100 roles, despite pulling in record revenues. Now, why on earth would they do that? Well, CEO Matthew Prince wasn't just indiscriminately hacking away at costs. He was actively replacing low-leverage support roles with agent orchestration. By dropping their headcount 20%, they are targeting an 8% increase in projected net income margin. Their remaining employees now oversee thousands of AI agent sessions a day, spanning HR, finance, and engineering. Ultimately, they're targeting a Rule of 50 profitability score by 2027, meaning their revenue growth rate plus their profit margin will equal an elite, world-class 50%. And this isn't some isolated, one-off event. Look at the other operational pioneers validating this trend. Bill.com executed a 30% workforce cut, transitioning to expert agents for the financial back office. Their invoice coding agent reduced manual coding steps by 89%. Just think about the thousands of tedious hours of data entry basically vaporized overnight. Upwork, a platform literally built on providing human talent, reduced its own headcount by 24% to deploy Uma, an AI agent that manages hiring faster and more efficiently than a human recruiter ever could. When payroll is successfully swapped for compute at this massive scale, the company's stock jumps because their margin floor fundamentally and permanently rises. This leads us to how institutional investors actually measure this success. Section 4, redefining the RPE benchmark. So the crucial point is that the ultimate benchmark for 2026 comes down to one specific dramatic number: $1 million. This is the new revenue per employee, or RPE target, for legacy software as a service companies pivoting to AI. In the old days of tech, a SaaS company was considered extremely high performing if it brought in $300,000 to $500,000 per employee. Well, not anymore. The bar has officially been raised. Let's look at the actual tiers of performance today. A traditional SaaS company sits around $395,000 per employee. High performers using AI to augment humans hit about $700,000. But look at the AI native startups. Perplexity is driving $3 million per employee. Midjourney, they generate $500 million in revenue with just 107 employees. Let that sink in. That is an astonishing $18 million per employee. This crazy 10x shift is possible because agentic models completely eliminate what we call the human coordination tax. Think about it: massive middle management layers, endless status meetings, communication silos, and constant operational handoffs. AI agents don't need catch-up meetings, right? They don't play office politics, they just execute. But hey, this massive opportunity also masks a profound danger. Moving to Section 5, the AI washing stock trap. Here's the brutal macroeconomic truth that routinely catches retail investors completely off guard. The entire information employment sector has actually shrunk by 11% since late 2022. People buy the dip on companies announcing layoffs, just blindly assuming a stock rebound is guaranteed. But the data shows that 95% of companies that adopted AI in 2025 saw absolutely zero meaningful productivity gains. Zero. Many companies are just slapping AI on a press release as a PR shield to mask standard business failures or massive pandemic-era overhiring. Honestly, adding AI to your name today is essentially the new pivot to video. If you aren't careful, you become exit liquidity for the 72-hour AI pump. And here's the exact playbook. First, a failing company slaps the word agentic AI, or GPU, into an SEC filing. Trading algorithms scan the keyword and boom, the price instantly surges 200%. Second, retail investors see the spike, they get severe FOMO, and they jump in, driving volume up thousands of percent. Third, insiders who hold the stock use this massive buying pressure to sell their worthless shares at a huge profit. Fourth, within 72 hours, the hype dies, liquidity completely vanishes, and the stock crashes hard. We saw a company called Mycium surge 270% literally just by adding AI to its name before crashing right back down to reality. So how do you avoid this trap? You've got to look at the technicals. If a company fires 20% of its staff, but its revenue per employee doesn't immediately climb, it's a trap. If their SaaS magic number drops below 0.5, which means they aren't generating enough new recurring revenue to justify their sales and marketing spend, they simply aren't growing efficiently. If gross revenue retention drops below 85%, it means their shiny new AI customer service bots are actively frustrating clients and driving them away. And definitely beware the Turing trap. That's when a CEO just tries to make AI mimic human behavior to save a few bucks, rather than actually using it to structurally expand the company's entire capability. Now that we know exactly what to avoid, let's tie it all together into an actionable thesis in Section 6, Mastering Margin-Driven Alpha. This quote right here from Block's CEO, Jack Dorsey, has essentially become the rallying cry for Silicon Valley boardrooms in 2026. 100 people plus AI equals 1,000 people. Block is projecting a massive 160% productivity jump by shifting to a flattened mini AGI structure. And the market fiercely rewards this because shrinking the denominator, which is the headcount, artificially boosts profitability metrics. It creates immediate price-to-earnings expansion, making the stock look significantly more valuable basically overnight. Guys, this isn't just a fleeting trend. It is the fundamental structural rewrite of the corporate operating model. And this brilliantly illustrates your marching orders as an investor. If you really want to capture this alpha, don't just chase AI headlines or top-line revenue hype. Watch the margin execution. Track if Cloudflare actually hits its Rule of 50 profitability target. Monitor Bill.com's earnings to see if the AI tool costs somehow erase the payroll savings, or if those margins genuinely, truly expand. Analyze if Upwork's new AI agents can successfully offset the revenue they lose as their clients require fewer software seats to get their own work done. Let's leave off with this thought. We are entering what economists are starting to call the E-shaped economy. It's this structural divide where value capture is increasingly reserved for those who hold equity and assets while the traditional wage-earning class shrinks. The brutal truth of the data is that software is rapidly, irreversibly decoupling human headcount from revenue generation. So as you navigate the markets this year, ask yourself, are your investments truly positioned for a world where software makes the workforce invisible? Thank you so much for joining us for this explainer. Keep your focus on the data, and we'll see you next time.